but it's coming because once the Fed hits the pedal to the metal, that should be it. And that's going to come on the next and final banking crisis, which is approaching pretty soon. And there's a lot of controversy going on about whether silver is in a bubble, whether silver is money. A lot of it's going on X, and it looks like Grok is mentioning me in the silver news, or that might just be tailored for me by the algorithm, and nobody else is seeing it. I don't know what's going on, but there's a lot that has to be clarified here. There are actors or people in the silver and gold community that are making some moves that some people think that I might disagree with, that I actually don't disagree with. One of them is Rick Rule, said that he's sold most of his physical silver. I don't know how much, maybe 80% or something. I'm not selling my physical silver, but I wouldn't consider selling physical silver in favor of gold miners. Really selling your silver. It's just changing the form of silver that you own. And I can understand why Rick Rule is doing this, though I'm not personally doing it. At this point, with silver at $110 and it being unclear what exactly is causing it, because first of all, the Fed is not printing that much. They're not pushing their foot on the pedal. It's not pedal to the metal right now. SLV is not being hoarded. Junk silver premiums are negative. Open interest is not rising. So what is going on here, and who is buying silver at $110 an ounce? Since that's not clear, and because the silver miners to silver ratio is very, very low now, near record lows, meaning silver miners are very undervalued relative to the price of silver right now, almost historically, I can understand why people would sell some of their silver bullion, some of their junk silver, or whatever it is they have, for silver miners. It makes some amount of sense. However, where I do stand out is that I understand that silver is still money, and using silver to acquire dollar profits is not going to work in the end game. The question is, are we in the end game right now? Is this the parabola that causes the end game? I don't think it is, because there's still one more dollar crunch ahead of us. There's going to be a huge spurt for demand for the dollar, not because people suddenly think it's money again, and it has really it has very little to do with whether people like the dollar or don't like the dollar, or they decide that the dollar is no longer what they want to hold. The fact is, the monetary system on the planet is still dollar-based, and people's, especially international debtors, have dollar-denominated debt. So it doesn't matter. It doesn't really make a difference whether they like the dollar or not. They still have to have dollars to service their debt. So, for example, what could end up happening here is that a company, let's say a Chinese company that's hoarding silver to produce its solar panels, if they have to suddenly pay down their debt and they have all this extra silver at a high price and there's a dollar crunch, they might have to sell their silver to service their debt to stay in business. This is still possible. I think it's even likely. Now, the question is, how high will silver go before this crunch happens? Will it go up to 200, 250, 300? I really have no idea. But after that top, wherever it might be, silver is going to crash, probably. I don't know to what. It could go from maybe $200 to $100, and the $100 could be the new bottom. But it could be anything. But the fact is, there's probably going to be one more crash. So I don't want people saying that, oh, Rafi was saying that silver's just going to go parabolic in the end game already. We're not, because there still has to be one more dollar crunch. It might not be the end game right now, but it's coming, because once the Fed hits the pedal to the metal, that should be it. And that's going to come on the next and final banking crisis, which is approaching pretty soon. When exactly? I really wish I knew. The slides. Before we get into silver, I just wanted to go into what's happening in Japan right now. Japan is struggling with the yen, trying to keep it below 160 per dollar, and there are rumors that the United States or the Federal Reserve or the banking system or whatever it is that's acting on Japan's behalf or with Japan to strengthen the yen is moving together with them to keep the yen steady. Why does the yen need to be steady? Because the yen is a load-bearing candy cane of the monetary system.
Oh, that's a load-bearing candy cane, you clumsy oaf!
Because they are the most inflated currency in terms of debt to GDP, in terms of their Keynesian extremism. They've gone from kamikaze culture to kamikaze culture monetarily. Takaichi warns Japan is ready to act on speculative moves. That means that she's threatening to buy the yen if the yen goes below a certain amount. And she says here, very contradictory, as politicians often are, "It is not for me as a prime minister to comment on matters," this is from Bloomberg, by the way, "that should be determined by the market, but we will take all necessary measures to address speculative and highly abnormal movements." So she says, it's not for me to comment, but here I'm commenting and I'm saying we will do everything we can. And if you defy me, I will do whatever it is that I do as a Japanese prime minister. Takaichi didn't specify if her comments were related to Japanese government bond yields or the yen.
They're the same face! Doesn't anyone notice this? I feel like I'm taking crazy pills!
Government officials have recently made several warning comments regarding both markets. They are threatening the markets and the markets are reacting. You'll see that in the next slide here. This is when Takaichi made her statement. It was the yen was collapsing towards 160, you see, and then she said something, and then this happened. There was a little zigzag over there, and then it really started to fall. Falling here means strengthening. Instead of 158 per dollar, it's 155.67 per dollar. This is going to happen as politics fight the market. The market will ultimately win. Politics is too weak to deal with the awesomeness of the market. It cannot win, but it can wobble the graph for a while. But anyway, Japan bond wipeout was triggered by just $280 million of trading. That's it. This is also from Bloomberg. It took just $280 million of trading to push Japan's 7.2 trillion, whatever. These numbers don't mean anything anymore anyway. Government bond market into meltdown. That was the combined turnover of the country's benchmark ultra-long maturity bonds as they plummeted on Tuesday, unleashing a $41 billion wipeout across the Japanese curve that sent shockwaves through global markets. The rout pushed yields to record levels, stoked worries that Japan was heading into a Liz Truss moment. Remember Liz Truss? That was the prime minister that lasted about 6 hours in the UK, and there was this other treasury guy, or whatever they call it in England, Kwasi Kwarteng. He also got fired. Anyway, and he led U.S. Treasury Secretary Scott Bessent seek research for what he called a 6 standard deviation move. That's a lot of standard deviations. I think 6 is the maximum. I don't know. I don't know how these statistics work. I don't really care either. It's just a lot. The 30 and 40-year bond notes were the worst hit during Tuesday's trading session, which several market participants described as the most chaotic in recent memory. Well, how long is their memory? If they have, memory problems, then it's not that much. But anyway, we're going to go to the next slide here, and now we're going to start talking about silver. So, what is going on in Shanghai? In Shanghai, the silver stocks in their exchanges are at a low that goes back to 2013. It's not a record low, but it's a recent low, and it keeps getting drained. We're at 506 tons, and this is the stuff that they take out in order to stockpile it for their solar panel manufacturing stuff. These are not stackers, these are industrial users, mainly drainage.
What's happening right now is the part of the movie where the music gets tense. The extras start glancing nervously at each other, and you, sitting in the audience with your popcorn, start realizing, oh, this is where the plot suddenly accelerates. Silver is not just rising, it's behaving like something that finally had its muzzle ripped off. And the funniest part is that everyone is trying to explain this as if it's a normal bull market. A normal bull market? No. This is what it looks like when a market that has been suffocated for decades suddenly gets a pocket of oxygen. The move isn't polite, it isn't linear, and it sure as hell isn't overbought. It's the scream of a system trying to correct 50 years of distortion in a few violent months. So let's get something straight for all the confused analysts on X, on C, and BC, and in the silver is a bubble comment section of every post I write. Nothing about silver's behavior right now is indicative of a bubble. In fact, the very people screaming bubble would not recognize a bubble if it bit them on the ankle and asked for a latte. Bubbles require participation. They require enthusiasm. They require retail euphoria. They require your Uber driver telling you to buy silver. Has that happened? No. You know what's actually happening? Retail has been selling. Junk silver premiums are negative. SLV is being shunned, not hoarded. Open interest is stagnant. The Fed is not printing aggressively. The money supply isn't exploding. So why is silver at $110? And who is buying it? That's what makes this move so mystifying and so terrifying to the mainstream analysts. When a market moves violently without the usual signals, no QE, no speculative blow-off, no big ETF inflows, It tells you something deeper is shifting. Something structural, something monetary. And yes, I know that sounds conspiratorial, but monetary reality tends to feel conspiratorial because it happens behind closed doors, between central bankers who speak in riddles, and policymakers who pretend to know what they're doing while actually hoping nobody notices that they don't. Now, I know some of you saw Rick Rule's recent comments about selling most of his physical silver, and there's been a lot of noise about that. Let me clarify my position, because people keep tagging me as if I'm going to pick a fight. I'm not. Rick Rule is not selling silver, in the sense that people think. He's rotating into silver miners. He's changing the form of silver exposure he owns. That is entirely rational, given his expertise. The silver to silver miner ratio is at record lows. Miners are grossly undervalued relative to the metal. If you're Rick Rule, if you've spent 50 years analyzing mining balance sheets and walking underground with a flashlight poking at ore samples, it makes perfect sense. But I am not Rick Rule, and many of you watching are not Rick Rule. And I remain convinced silver is money, and swapping monetary metal for dollar profits is not a winning strategy at the end of a monetary regime. The question, the big question, is, are we in the end game? Is this the parabola that breaks the system? And my answer is simply, not yet. We are approaching it. We are smelling it. We are hearing the creaks in the rafters. But there is still one more dollar crunch coming. One more violent scramble for liquidity. One more moment when the world suddenly realizes, oh no, we need dollars to service our dollar-denominated debt, and we don't have them. And that dollar spike, as absurd as it sounds, will hit before the final fall. This is why people get confused. They think nobody likes the dollar, therefore it must collapse immediately. But people liking the dollar has never been the mechanism that supports it. The mechanism is debt, specifically global dollar liabilities. If you are a corporation in China with debt denominated in dollars, and the dollar suddenly strengthens, it doesn't matter if you hate the dollar with the fury of 1,000 suns. You must acquire it. And to acquire it, you may need to sell assets, including, yes, silver. Which is why even in a bull market this powerful, the crash will still come. The question is how high silver goes before that liquidity event hits. $200? $300? Higher? Nobody knows. And anyone who claims they know is either lying or writing clickbait. Now before we come back to silver, let's talk Japan, because it is the most fragile piece of the entire global monetary Jenga tower. The yen is the load-bearing candy cane of the international system. And yes, I intentionally call it a load-bearing candy cane because it wiggles, it bends, it bows in the wind, and one day it will snap. Politicians in Japan are desperately trying to keep the yen from collapsing below 160 per dollar. They issue warnings. They threaten intervention. They say things like, "It is not for me to comment on the market, but we will take all necessary steps," which is the kind of sentence politicians say when they are panicking and trying not to sound like they are panicking. Why is Japan so important? Because Japan is the most leveraged major economy in the world. Their debt to GDP makes the US look like a paragon of fiscal responsibility. Their entire system is a delicate balance of yield curve control, hidden interventions, and whispered reassurances. And it only took $280 million of bond trading in a $7 trillion market to trigger a meltdown. That is not a healthy system. That is a dry forest waiting for a spark. That is exactly the kind of market that collapses first in a global liquidity crisis. Which brings us back to silver, because the yen, the dollar, the bond markets, the liquidity stress, all connect to the same ultimate narrative. The system is running out of trust. The system is running out of buffers. The system is running out of excuses. Meanwhile, Shanghai, the world's industrial heartbeat, is draining silver inventories to decade lows. 56 tons, not stacker silver, industrial silver, solar panel making silver. Silver that gets consumed, not hoarded. silver that does not return to the market. And this is happening before the final monetary crisis, before the banking collapse, before the Fed hits the pedal to the metal. Once that happens, once the Fed panics again, as it inevitably will, then we enter the real endgame. Then silver stops being an industrial metal and becomes what it has always been: the people's money, the sound money of history, the monetary metal that governments hate because they cannot control it. But we're not there yet. This is the prelude, the overture, the tightening of the springs. You want to know why silver is exploding even without Fed printing? Even without retail mania? Even without ETF hoarding? Because paper silver and physical silver have finally diverged. The paper tail can no longer wag the physical dog. Comics can't keep the illusion going when delivery demand breaks records month after month after month. You cannot deliver what you do not have, no matter how many contracts you print. The physical world is asserting itself, and when physical wins, paper burns. My warning months ago, buckle up, wasn't based on chart patterns or breakouts. It was based on the collision course between fantasy pricing and physical reality. And now, we're watching that collision in real time. And it's only beginning.